Hello, hello. Welcome everyone to Spero Ventures Fundraising Series Session 6. I think everyone is trickling in here, so I'll just wait a few minutes or a few seconds before I get started. I am Veronica Reeves-Parks. I am a venture associate at Spero, and I will be moderating today's session.
Good morning, Veronica.
Good morning, panelists.
Good to see you. And good morning to everyone who joined.
Yeah.
Good morning, everyone.
So we're going to go ahead and get started. So just a quick overview, but first let me just welcome everyone who's been here before. This is session 6 out of 7. So welcome back. If this is your first time joining, and welcome, we're glad to have you. So a little bit about Spero Ventures. Spero Ventures is an early stage investment fund, meaning it invests at the seed and Series A round. And Spero invests in the things that make life worth living. Particularly, we invest in 3 key areas. We invest in work and purpose, well-being. That means well-being for ourselves, also for the planet, and also human connection. So think community. And we really try to look for founders that are core to their purpose, really making life better. So that is Spero, and that's what we focus on. In terms of our team, you'll see we've got an array of different folks on the team. And who you have today for our Ask Me Anything session, you have Ha Nguyen, who is a partner at Spero. You have Sunny Maeva, who's our entrepreneur in residence, and you have Sarah Eshelman, who is our principal. And so they'll introduce themselves in just a second. So while you're here, please feel free to share your learnings on Twitter. Here are the handles for Spero Ventures, Sunny, Poker Girl Ha, Sarah, and me. And with that, I'm going to stop sharing and pass it off to Sarah to introduce herself.
Good morning, everyone. Great to see so many faces on the screen, especially at this early hour for some of you on the West Coast. By way of introduction, I'm a principal, as Veronica said, at Spero Ventures. Have been with the firm since we launched, part of the founding team along with Ha. And have been investing for 6 or 7 years with originally the Omidyar Network, which is our kind of sister organization at this point, and now with Spero. So I tend to focus on more of our well-being vertical as well as work and purpose, and have been particularly interested in the human health and sort of health of the planet areas of opportunity recently. So originally I was a management consultant, spent several years working across a variety of different industries there before moving into the venture world. So such a pleasure to see you all this morning, and I guess I'll kick it over to Sunny.
Thanks, Sarah. Good morning or good afternoon, depending on your time zone. Thank you all for coming and joining in the session. My name is Sunny Mayuba. Honored to be here. I'm the entrepreneur in residence at Spero Ventures. So what that means is I work closely with portfolio companies on strategic objectives and plans and strategies and execution to better the companies. I do a little bit of diligence and deal flow, and then I work also very closely with Ha and Veronica and Sarah on branding and marketing for Spero Ventures as a firm. Where I come from, I've been a founder my whole career, starting back in the 1990s in Web 1.0, where I started an action sports lifestyle youth magazine that was acquired at the age of 25, went on and did a few other ventures, most recently started a mobile app in the food tech space that went from napkin to NASDAQ. So that's me, and I'll kick it over to my colleague Ha.
Good morning, everyone. I'm one of the founding partners of Spero Ventures, and a little bit about my background. I've been in Silicon Valley for 20 years, the first 16 years as a product leader at early mid-stage startups. The very first one was joining eBay in 2000, where I got a chance to stay for 5 magical years during a period of hypergrowth. And after that, I led the product and design teams for 4 other early to mid-stage startups, a couple that had successful outcomes and a couple that failed. So I've, like Sunny, I've seen the ups and downs of the startup journey, but not as a founder, but always as an early employee and early executive. And then I joined Omidyar Network about 4 or 5 years ago. That's where I launched my career in venture. And then 2.5 years ago, as Sarah mentioned, we started Spero Ventures. So I'm thrilled to be part of this session. I see so many familiar faces on the screen. And yeah, I'm excited to help answer any questions that you might have remaining on the fundraising process.
Awesome. Well, thank you, panelists. Super excited to be here with you all as well. And so just a reminder, founders, please drop your questions in our chat. That's where we're going to be pulling from for our Ask Me Anything. I'm going to kick off with each of the panelists with a question, and then we're going to turn it over to the audience. So this hour truly is yours to get your question answered to an investor. And so I want to start with you, Sarah. You've mentioned you worked at Omidyar Network, now you're at Spero. You've seen plenty of pitch decks. So once a founder is able to get, the holy grail of that initial call, what are you looking for from them in that first conversation?
Sure. It's a great question. And I think a couple of different areas of focus for us in that initial conversation. Number one, and I think this is like what's most sort of in the founder's control, is to make sure that the investor really understands why you're pursuing this. I think sometimes folks kind of jump right into like, what is the product and what is the market opportunity? But, investing, especially at the seed stage and pre-seed stage, really early, we're investing in the team, we're investing in the founding team. And the way I like to say it is, we want to invest in founders that cannot not pursue this idea. There's something about this idea that's hooked them so deeply that this is kind of their life's work, their mission to bring this idea to life. And I think, telling the story of how, you as a founder came to this opportunity, came to this product or technology is really a key starting point. And again, a place that I sometimes see people underinvest in, they want to jump right into the business metrics or right into the size of the market. And those are important and we'll definitely come to those, but start off with the story and really kind of the personal passion that this arises from. So that's number one is the founder, and really at this stage, that's what we're investing in. Second to that, fit with the fund, I think, is something that folks can evaluate and sort of have a bit of a story around before going into a meeting. All VCs more or less have a website and talk about the kinds of things that they invest in, and just making sure that there's sort of a basic fit there. I think it's often a fair question to put to the investor, like, why did you take this meeting? Why are you interested in my company? And I like when people do that because it kind of flips the dynamic a little bit. Instead of just sort of sitting back and being told a story, we're, asked to participate actively and tell you why we're spending our time, we're spending your time. So that's something I would think about doing, is sort of just really like understanding the fit with the fund. Another area, and we can talk about this more, understanding like what is the product, what is the sort of go-to-market strategy, sort of the basic nuts and bolts of the business is an important thing to make sure that there's sort of a basic level of understanding of early on. Where two areas that I feel very strongly about in that initial meeting are understanding kind of what is the customer pull. That sort of, Ha talks a lot about customer love, and she may talk about that on this panel. But what is it about your product that customers are really, hooked on? What's catching fire and why? So that's a piece that I really like to understand in that initial meeting. And then we can get into this further. Some people call it defensibility. Some people call it an unfair advantage. Some people call it, sort of your unique insight on the market. But whatever it is, I want to understand what is going to make you and your company win against, what could be, there may be no competitors today, but if this is such a great idea with such a big, compelling market, there will be, inevitably. And so what is it about your approach, your team, your product that's going to cause you sort of structurally to win? With sort of deeper tech opportunities, that may be a patent portfolio. With more consumer oriented opportunities, that may be some unique insight or unique way that you're interacting with the customer that nobody else has done. Oftentimes we write a lot about community and the power of community and sort of generating a unique experience, but also a unique experience that's really hard to replicate. So there are lots of different ways that you can get to that sort of structural unfair advantage. But that's something, especially early days when there's not a whole lot of data to say like, yes, this is really taking off, thousands, tens of thousands of people are buying this product or service. I need to kind of understand the intuition behind that. So I'll stop there. Those are kind of some of the big areas, and we can certainly dig into any of them further.
So to summarize, it sounds like founders have a story, know why you're pursuing it, and be able to tell that story, understand if you have fit within the fund to as best as your ability, understand what customer love you have, and how will your company win. I think those are great pieces of advice. And so just to touch on customer love, I'd love to ask you, Ha, what is customer love? And when you're early stage, seed, Series A, maybe even pre-seed, how can you demonstrate customer love?
Yeah, so thank you, Veronica, for the question. Actually, I am about to publish a blog post maybe next week on exactly that. And so as part of the post, I define sort of 4 things that sort of indicate customer love. So the first one is revenue. So I do want to sort of see that there is, as Sarah said, like a pull in the market, and people not only are using the product, but are willing to pay for the product, because that is 2 different things. And so I often sort of say it as, will the dog eat the dog food? And what we really want to see, I think, not just Spero, but a lot of VCs want to see is some history and some sort of traction and growth around revenue, right? So if you have been in market for 4 or 5 months, that's okay. But if it's those 4 or 5 months, it's sort of spiky up and down, or sort of flat, or maybe only 1 month of growth, like it's not really telling me enough of a story around your business. And so I do think, you really should think about when you go out to market, at least in the fundraise process, to pitch to VCs. Angels are a little bit different. They might just fund on an idea, but a lot of VCs will want to see 4 to 6 months of growth up into the right charts. The second sort of criteria to me that helps us understand customer love is your product a vitamin or a painkiller? And so I call this like, do you really have like the pain-killing power around your product, right? And so the best way for you to understand whether you have a product that's a painkiller versus a vitamin is to really talk to your customers and really understand first, before you define a solution, like what is the pain that they're going through? Like, so understand their world, their needs, like their habits, but like, what is putting like their hair on fire that like, if they could only find a solution that doesn't exist yet, they would absolutely have to use that. And so if you could figure out that pain point and then have a solution for that, like that's a good indication of like, hey, like there's something there. And as VCs, we always do customer references. So we'll talk to existing customers, and we'll also talk to non-customers, or who are in your target market, and ask those exact questions. And so if we're not hearing during those customer interviews that like, wow, like this is really solving a pain, it's a must-have, like I would feel totally lost without it, then if we're not hearing that, it's unlikely that we'll be able to invest. We often hear it's like, yeah, it's fine, it's solves this like little thing, but and then you ask the question like, would you like, how sad would you be if this product no longer exists? And so like, and so that sort of tells me that's, maybe your product isn't a painkiller. Then the third thing that I think we look for in terms of love is referrals, right? So do you love it so much that you're willing to go to bat and tell a friend or a colleague or another company about the product? And so that often is measured by NPS, Net Promoter Score, right? The question there is, on a scale of 0 to 10, how likely would you be to tell a friend or a colleague about the product? And we really want to see sort of higher NPS scores. But we also want to not only just see like what they say they would do, but are they actually doing it? So we'll also dig into the data to see, well, what percentage of your traffic is coming on like organic or word of mouth, as opposed to say paid or SEO even, because you can't always control those things. Like paid, the unit economics might not make sense, and SEO, you can't always control SEO. So we really do want to sort of see that people are organically adopting the product because of amazing word of mouth. And then the last is retention. So retention is really important. So we do want to look at customer cohort curves. We want to understand sort of over time, are users sticking with the product or are they dropping off? Like, are they churning from the product or are they sticking? And then also when I say cohort curves, I want to understand that month over each month, the new cohorts that are coming to your product are sticking around longer than the old cohorts, which means that your product is getting better over time. So I could go on, but I will share out the blog post after it gets published. And those are sort of the 4 things that I'm looking for to sort of be a sort of indicator of customer love.
Okay, awesome. Yeah, I think core to each of those 4 is really just understanding how your customer engages with your product, how they feel about your product or service, and are they willing to recommend it to other folks, and are they doing that? I think also organic versus paid growth is really key. So founders, be sure to take a look at both of those channels and see how you're doing there. So Sunny, I want to transition to you. You've taken a company from napkin to NASDAQ. You've gotten to ring the bell, but you really epitomize the Spero mantra of never giving up. So I'd love to hear your story, as a founder. Can you talk about how you saved, requested from almost certain death to ringing the NASDAQ bell? So a little bit about that story and how you were able to turn things around and never give up as a founder.
I'll keep it really brief because that could go on for a while. For the founders in the room, you know what I'm talking about. But in essence, it came down to a few different things. So the story is that I had a company at a mobile app where you could name your own price at restaurants and bars. Really great idea. You're all probably thinking, ooh, that'd be really cool. I wish I could do that. Pay less during off-peak times. I'll pay more during peak times to get a table, right? Sounds pretty great. We built it and it worked. We made the machine work, but what Ha was talking about, it's about what were the customers doing once they found the product, and they weren't sticking. It wasn't working in the market for various reasons. So when you get to that point and you've got a staff of 9 and you've taken investor money, and Sarah's giving you money and she's taking a bet on you because she thinks you're the founder that has to build this, you'll be facing a choice, and just about every founder goes through this. It's basically when it gets really, really hard. And the choice is, do I quit? Because it's actually pretty easy to quit. It's just like hang it up, bankrupt the company, move on. And it sucks, it hurts emotionally, but sometimes you got to move on. Or do I commit? And really that's what it comes down to, was commitment. So on this one, I was just super, super committed to making something happen, or as they say in sailing, right? The captain's going to go down with the ship. Like, we're going to keep sailing until literally this wave eats us up, or we're going to break through this storm, right? And it can go either way. So on that one, what happened was, it wasn't just that we left it to blind luck. What happened was, even though the company wasn't working, I created 4 paths forward for the company. So one was created a new business model, which was licensing our software. 2 was went out to raise more money. 3 was trying to sell the company. And then 4 was trying to make the company work. You got to keep trying to make your company work. So trying to find a pathway out. The funny thing was, and I will spare you the details, a little bit of all those things happened. That was the interesting thing that would surprise everybody. It wasn't like, oh, the company got bought and we got saved. A little bit of all those things happened. And we ended up merging with another small company and started building both companies at the same time. We built Requested, which was dynamic pricing, and the company was called Waiter. We were building food delivery. And we quickly saw, side by side, one dog was winning the race. So we shut Requested down, leaned into Waiter, and built it for, it never worked that hard, but worked hard, really, really hard, and then grew the company pretty large, had a large exit and took it public. So it really came down to just heavy duty commitment and making sure you go like the full distance.
Wow, thank you for sharing that. So we're going to actually move to the question and answer portion. So the rest of this hour is really for our audience members, and we're going to start with Dominique. So Dominique, if you can unmute yourself, turn on your video, and ask your question.
Hi. Yes, so my question is, I've heard that a lot of VC firms, they don't like to do safes anymore. They want to do different types of terms. So I want to know if that was accurate in the market, and what are the practical terms that VC firms like yours rather have.
Hey, Dominique, your volume is short, but if you can't fix the audio, then Veronica, I think could just read off the question too.
It was just a little bit difficult to hear you, Dominique, but I think your question is around what kinds of tools do VCs like to use at the pre-seed level, safes versus notes? Is it true that most VC firms don't like safes?
That's correct.
Okay, perfect.
I'm happy to jump in on that to start. I think as an investor, one of our concerns with safes and convertible notes more broadly is that, especially at the early stage, it is a convenient instrument. It's a low kind of transaction cost, low legal expense way of raising money, and especially from smaller investors, angel investors, kind of $50,000 to $100,000 checks. It's an easy way to collect up that kind of money. The risk, though, is that you do that for 12 months, 18 months, and it's hard to know exactly what that is going to ultimately do to founder ownership. And we've had a number of experiences where a company's gone and only raised on notes for 2 or 3 years. And, at the time that we come in to do a priced round, it's a real surprise to founders to see what kind of dilution they've ultimately taken. Because not only, I think one of the mistakes sometimes that founders make is they think about the valuation cap as like, oh, if I'm raising $1 million on a $10 million valuation cap, well, I'm only selling 10% of my company. And that might be true, but it might also be true that, the next equity financing happens at a lower price than the valuation cap, in which case you're selling, more than 10%. Usually those notes come with a discount, usually around 20%. So, it can kind of quickly escalate to a point where the founder, at the end of, when all those notes convert, may have only 50% of the company or something. And so for us, the reason that we encourage founders to, eventually do a priced round is because we want everyone to understand what their ownership is, and just have sort of clear eyes, full information about what the what the investors are going to own, what the founders are going to own, what amount is going to be available for, team options and all of that. So it's really just a clarity thing. But I do think it makes sense at the very early stages to use, a note to bring in smaller checks. Like the cost of having a lawyer review, a full set of financing docs and everything can be, easily $10,000, often a lot more. So it makes sense up to a certain point. And then I think, once you've raised, upwards of $1 million, you're starting to talk to institutional investors, they're often going to want you to convert those notes and do a priced round for the reasons I stated.
Dominica, is your question around notes versus safes versus price rounds, or just the safe vehicle in general, and whether investors are okay with investing using a safe instrument? Your audio went. All right. Well, let me. We can't hear you, Dominic. Let me just note that at least for a lot of West Coast investors, like, they're comfortable coming in with safe, and it's an instrument that YC sort of is in favor of because it is simpler than a note. I've heard differences between West Coast investors and East Coast investors. I think the East Coast investors prefer a convertible debt instrument, but so it is something to talk to investors about. But we have come in and invested through a safe instrument, and it's been fine.
Okay, thank you.
Thank you. So next we have a question from Naomi in the audience. So Naomi, if you can, please unmute yourself and ask your question live.
Sure. So good morning, everyone. I met we are like an idea pitching stage, and I met like 2 investors this week, and both of them asked me completely different questions. They have a completely different expectation, and I can see myself now going into this route of like asking investors, but like, how do you keep up? At the end of the day, the answer is no, but like, how do you at least narrow it down to the questions that venture capitalists are looking for?
I'll jump on that one. I think, and I got to make sure I understand your question, Naomi. You can't really narrow down the questions that they're going to be looking for. There'll be some basic questions that always get asked. How are you going to win? How are you going to get users? How are you going to get customers? How much do you charge? What's your business model? All the basic stuff. So make sure you know your basics and your fundamentals. And then think of it like a layered cake. That's the foundation, right? Then you've got a second layer, which would be, well, what's the competition like? How are you going to beat, how are you going to beat Uber? How are you going to beat, Salesforce if you're a CRM, whatever. So you need to know how you're going to do that. What's novel about your company on that? And then there'll be some oddball questions that you could never predict. As long as you know your business, and most importantly, know your space. That's really the key for if you're in idea stage. Most of these questions are going to be hypothetical, meaning how are you going to win? How are you going to get users? Well, it's just a guess right now. And so either they believe you or they don't. And that's what they're bet on. But if you don't know your space, they're never going to give you a check. If you really know your space, what space are you in, by the way? Like what industry? She's on mute. Yeah.
Yeah, I'm trying to unmute.
This is
going to be like social service, because we're trying to encourage women and minority investors to connect with venture capitalists. So okay. I get a feedback. One of them told me that, venture capitalists are not going to be interested to invest in social cause, and the other was like, yeah, we'll keep you on the list. Yeah.
Right. So you're going to get, even when you're $1 billion company, everyone's going to tell you their opinion, and they're going to think they're right. All that matters is that you're right. Know your space really well. Make sure you know your vision and your roadmap and your path, and just keep charging down that path. And just, make sure you have answers to questions, because everyone's going to have an opinion. Oh, we'll never invest in, a very predominant feeling is, oh, education. Oh, don't invest in ed tech. Takes too long. You don't make enough money, et cetera, et cetera. That's some investors' viewpoint. Other investors will say, oh, it's the greatest thing in the world. We need to do it. Some are, so everyone's going to have their opinions. What's important is you know your space and you know your business and your model, so you have the answers that they're asking.
One thing I had to add to what Sunny said is that, like, before you go into any investor meeting, do your homework on them, do your research, right? So make sure you go to their website and see and understand really what stage they're investing. And then if you're meeting with a particular partner, like, what have they written about? Because oftentimes that will clue you in on what they care about and what they want to see. And knowing that, like, you'll be better prepared, right? Because there will be some investors who are okay investing pre-product idea stage. And so they're gonna wanna understand mostly about the team and the founder and the market. If you're talking to a post-product sort of post-traction investor, they're gonna drill in on the numbers. And so I do think it's really important before you go into any meeting, just understand your investor, and that will help the conversation a lot.
One more tactic I would chip in is to, when someone says, oh, we don't do ed tech, as Sunny offered as an example, ask them why. Like, what's really important, we have aligned incentives. We want to understand how this can become a $1 billion business. And so, so do you, I think. And so, for people who have some experience, looking at companies in a specific space, flip the dialogue, ask them what their concerns are, ask them why they think this might not work. What have they seen in the past that has, been, kind of a similar product or whatever, and why did it fail? I think those are really important insights that, it'd be a missed opportunity not to try to glean some of those in these kinds of meetings. So, the questions may come off, I guess, as adversarial at times, because, the goal is obviously to get the investment, but longer term, I think it's important to understand, like, already, some of the questions may not be valid, and it's fine to sort of dismiss those, but some of them, which are based on past experience, are great to try to, really capture.
Awesome. Thank you, Naomi, for the great question. We will turn to Kyle Jackson next. So Kyle, if you can unmute and ask your question.
Hello. I saw that Albert was before me. I don't know if you wanted to do that one first or.
We have them on our list, so we're curating in the background. Yep, so go for it.
So I had a question just about funding. How much traction should we have? And then also, when reaching out to people in a certain field that we feel like would be able to help us and have expertise in that field, how are we able to protect what we believe is our intellectual property and still get the info that we need from them? We've reached out to a few people, and one in particular, he kind of helped us, but then we saw that he went and did almost the same exact business model that we had. So we were kind of scared about that happening again.
I'll take the first part of the question. I don't know, maybe Sunny might want to take the second part of the question.
I'll do the second half.
Yeah, because you pitched a ton of investors, and you've sort of seen different investors' behaviors. So, how much traction should you need at the seed stage? Really, I think depends on what type of business you're building. So if you're building just a pure software business, say it's consumer or it's software as a service business, I do think most investors will want to see traction, because these days it's not that hard, to spin up a website and start a company. You don't need a whole lot of money to be able to spin up a new software business. And so I think investors will want to see their that you're able to, that there's something unique about the solution and that you're able to bring in customers and they're going to want to see some traction. And the amount of traction really depends on the stage. So if you're an early seed company, I mean, I think you want to get to at least 10 to 30,000 in monthly recurring revenue, with 4 to 6 months of growth up and to the right. If you're a consumer company, you might even need more revenue than that. Especially say if you're an e-commerce company or you're selling something online. And then of course, if you're talking to a later stage investor, they might even need more traction than that. But if you're building something that is like a hardware product or has some type of like unique IP defensibility, something that's really, really hard to build, you might not need that much traction, or you might not have any revenue. And an early seed investor might be very comfortable coming in with no revenue. So I do think it really depends on the type of business that you're working on. And I would, I think Sarah might have said this, but like I would ask the investor maybe at the end of your conversation, to give you feedback on what you presented, and if and if the traction or the stage, sort of fits what they're looking for. And if not, when should you come back to them? Like what metrics or milestones, would they want you to demonstrate before you sort of come back again? And by the way, like we have many founders who come and pitch us a second or third time. Maybe the first time they were too early. We did communicate what we're looking for, and then they come back, and we've had at least 1 or 2 examples in our portfolio where we ended up investing even after sort of the first or second no, because they were too early. So do ask these questions of the investors to get a feel for what they're looking for, because every investor will be also very different.
Yeah, and for the second half of the question, very, very tough to do. Protecting IP is just a big challenge, especially in the era of software, right? Because everybody can see what you can do. I mean, right? You need your customers to see what you're doing. If you have some very, very novel IP, of course, you can protect it with trademarks and patents. So that's one way. But even then, it's very hard to stop knockoffs. What I've always said is that it's about the execution. So I'll give you my example. We were in food delivery. Guess what? Hundreds and hundreds of companies do food delivery. You probably have 20 in your town where you are today. But we did a handful of things a little bit different, just strategically different. The way we went to market, photos on our app, our delivery fee, just a few things. But guess what? All of our competitors could see exactly what we could do, but it was the way we executed that built the moat around our company. More close to your question, when it comes to how you approach strategic partnerships, which I think is really the root of your question, that's just really you as CEO deciding. You've got to look and decide, is this partnership going to really add value to my company, and can I add value to their company? Then maybe take the meeting. If it's something that's going to be like, wow, I'm going to open up the books and show them everything, and it's not going to really add value either way, well, then you're just showing your secrets, and that's that, right? But look, if they're knocking you off, it's because you're doing something of value. So you got to take that and run with it. People are going to knock you off. And listen, you know who we beat? We beat a little tiny company called Amazon. Amazon was in food delivery, and we were scared. I'm just going to tell you straight up, like Amazon Restaurants was putting tons of money and tons of resources and thousands of people against all the food delivery companies, and they tucked tail and ran out of America and closed up shop. So just because somebody big knocks you off doesn't mean they're going to win.
Thank you, Sunny. Thank you, Ha, for that. Next, we're going to go to Albert. So Albert, please unmute and ask your question.
Sure. Good morning, everybody, or afternoon, where you are. My question is, how detailed does your business plan need to be when you're seeking funding? It doesn't matter what stage it is.
Happy to jump in on that. I think, it does depend on the stage. I think, for something that's like, kind of just an idea on a napkin, having a sense of what the business model might be, I think is always helpful for investors. You know, like certain business models will pull you in a certain direction. You know, like we've thought a lot about ad-based businesses and the kind of incentives and pressures that are on companies that are trying to monetize, you know, basically based on their users' attention. And, you know, there's trade-offs and things that I think you need to be thinking about from even the earliest days before you have the critical mass to generate any ad revenue, in order to, you know, sort of head off certain issues or certain you know, opportunities that may present themselves through that business model. So I think having a sense of where you're going to go is really important. But the level of detail is obviously going to depend on the stage of the business. So if it's, you know, something that may happen a year or two from now, having, you know, kind of a roadmap of how are we going to get there and what are sort of the intermediate milestones and proof points is going to be, you know, critical. Once you're at the stage where you're actually implementing that business model, we're going to want to see data, and we're going to want to see, like, is it actually, you know, as Ha said, are people paying for it? Are people actually, you know, sort of doing what you expected them to do? So, you know, I would say, like, have a sense, and I think for yourself, more so than for investors, you want to know kind of the direction that you're headed and how do you evaluate, you know, if it's working along the way. You know, and certainly investors are going to care about that too. But I think, you know, as a founder, having that clarity, even if it changes, even if, you know, you ultimately, you know, end up being wrong, I think knowing where you're going is important.
Yeah, I want to add on to that because Sarah's spot on. The stage of the company really matters. If you're at idea stage, or maybe you raise, you know, 100 grand just to build a little prototype, you do need to have some detail in there to know and be able to communicate. The real key about business plans are, one, you're proving to yourself, is there something here? So Sarah's right, it's for you. But two, can you communicate your idea? That's really the answer. Is if you need 47 slides to communicate your idea in a lot of detail, well, that's fine, build it, as long as you can communicate it well. If you need one thing that has been a trend lately is the one-page memo. If you don't know what that is, Google the one-page memo for fundraising. There's a small handful of companies that are raising on these just very succinct one-pagers. So that's kind of neat. Another resource that's really cool, it's a deck, but I think it plays into business plan, is Google Reid Hoffman's LinkedIn Series B deck. Beautiful piece of resource. I refer to it all the time. It's so he published their Series B deck and a bunch of narration on why he built each page and what's in there. So Ha doesn't love it, but you know, and she's the investor, so she's the expert. But I like it. I think it's really good. There's some good insights in there that I think are great.
Awesome, thank you. And so next we will go to Loretta. So Loretta, please unmute and ask your question.
Hey everybody, can you hear me? Yep. Okay, so thanks again for the sessions. I'm really excited to start pitching. Things are really ramping up for me, and I'm finding myself with lots and lots of questions. I'm first of all think that I need about 500 to 750K to get to my beta release. And so I remember a few weeks ago that somebody came along and talked about the friends and family round being like at less than 100K and angel being like less than 250K. So I don't understand if it's advised that I just skip to the bigger rounds, or if I do the smaller rounds back to back. And I think it's the latter, or maybe it's all just semantics. I don't know, I could use some advice on how to approach that. And I always manage to think of another question before my time comes. So the second part is like, if and when I'm doing a friends and family, I would like to hear like how far you guys, if anybody did this, reached. You know, because we all have like Facebook friends that they're not really your friend, but you worked with them and you haven't talked to them in like 10 years or something. And I'm sure it's probably just a matter of like what I'm comfortable with, but I would love to hear if you guys have any stories about that.
Why don't you take that that last question, and then
Okay.
I can jump in on the first question, but or Sarah can.
Take the second one first, Ha? Yeah? Okay. So yeah, I've raised a friends and family round actually multiple times. And you're asking, I think it sounds like you're asking about what's the etiquette on it. And, in my experience, it's been all about hustle and professionalism, straight up. So what I've done is when I have an idea that I firmly believe in, I reach out to people that haven't talked to, maybe not 10 years, but I haven't talked to in some time, that are wealthy individuals. Uh, that's cold outbound. That's one strategy. Hey, how's it going, Mark? I know we haven't talked in a while, but I have this really great idea. I'd like to show it to you, and I'm looking for investors. So are you open to the opportunity? That's kind of how I approach it. And they'll tell you, no, I'm not into investing right now, but if you want to show me the idea, great. Or yes, I'm totally open to ideas, and let's sit and meet. So that's cold outbound. The other strategy for friends and family is find all the people in your network and ask them, get them convinced first that this is this great idea you're working on, that's going to be this great company, and ask them to ask their friends. Most wealthy individuals hang out with other wealthy individuals, or have lines into family offices and lines into, maybe small funds or angel investors, and ask them if they would pull in their friends to hear the idea. Because typically they will. If they like it, they will. And then the best way to do it is somebody for sure is going to be in. So let's say you have a friend who's wealthy and says, God, great idea, Loretta. I'm in for 50. Then ask them to definitely bring 3 to 6 of their friends. Because the best signal is they say, hey, friends, come on in. I'm in this thing for 50 and I want you all to come in for 50 or 100. That's like the fastest way to raise your friends and family round.
Okay, cool. Thank you.
If with the second question, I think it's do you raise 2 or 3 sort of smaller rounds before you go raise the big round, or how should you approach it? Hopefully I got that question right. And so at least sort of my answer, and I think different investors might feel differently, but my thought is just that I don't like when founders are constantly going out to market and and always just trying to raise just a little bit. And the reason why is I think it's a distraction from running your business and growing your startup. And so I have a fundraising talk around this, but for me, I feel like it's better for you to really run a process and figure out how much you need to get to that next milestone, right? So you should always be looking ahead of okay, the next round of investors are looking for this, right? They're looking for 30,000 or to 50,000 in monthly recurring revenue. I know that. How much money do I need to be able to get enough progress to show that, before I start talking to the next round of investors? And so know how much you need now to get to that next milestone. And based on what you need now, I would just run a process of saying, okay, I'm going to spend the next 2 to 3 months. Actually, it often takes longer, but say 3 months doing nothing else but fundraising. And I'm going to delegate to my co-founder, hopefully, a lot of the business operations. And I'm just going to run this process where I'm going to spend full-time fundraising and get this money in the door, right? And so that, and we had a whole session around it, so I won't repeat sort of the process. Happy to share out the videos again, but it really is like building that massive investor list. And it could be a friends and family list, whatever it is. Go out and having all the initial conversations at once, build momentum around the round, and just get that money in the door, and then go back and focus on building your business for the next 12 to 18 months before you go out and raise again. But I just think that a recipe for disaster is that you're constantly always going out to market and fundraising and raising a little bit here and there, because you can never do 2 things great. And then it also, from a market perception, and I've seen this with founders, it's like, oh, she just talked to me 6 months ago and she's raising again. It doesn't look good. So it's not a good look. So.
Yeah, and to Ha's point, we will be sharing out all of our prior sessions. And I think in session 1, Lolita Taub did a really great job of talking about ways you can hustle some money. So working a side job or working, full-time if you can, and using that money for your startup. or using pitch competitions as a way to maybe get some money. I know, Loretta, you said you've got a target that's $750K for your prototype. And there was another session that we had, it might have been our third session with a founder named Vernon. And he said he took all of his Facebook contacts. He basically created an Excel list and, you know, started reaching out and went through that entire list. And you never know. So anyway, we'll make sure to share those out for folks so they can figure out creative ways to kind of fill that friends and family round, because we know that's a huge gap, especially for Black and Latinx founders. So our next question.
Can I just clarify really quick, like Ha's response? So I think what I'm hearing is that it's not necessary though for me to go through the lower rounds, like a friends and family, if I know I want a larger amount to get to beta. And in fact, it might be frowned upon if I'm like, have recently done rounds and then I'm going for like a bigger amount.
Yeah, I mean, I think raising a 500,000 to $1 million sort of pre-seed, early seed is what we see. I mean, that's very, very normal. So, and if you know that that's what you need, then just go raise it, and then but just figure out who should be on your target list, right? It does include friends and family. It does include angels, both micro angels and super angels, and it should probably include some pre-seed funds, like true pre-seed funds who are comfortable investing at the idea stage or, you know, very little traction stage, but like build that list and just go out and say, I'm raising 750,000, I'm raising $1 million. That's what, you know, what I need. And just one round,
gotcha.
Focused, 3 months, 4 months of fundraising, get it all in the door, and then just build your business for the next 12 to 18 months.
All right, cool. Thank you. Got it.
Awesome. So we will take one more question before we look to wrap up. So Brahm, hopefully I'm pronouncing that correctly, but please unmute yourself and ask your question.
Yeah, my question was around, you know, how to avoid the long no. Like, you know, what kind of pressure can you, I mean, to the extent you can put pressure on the venture capitalists to make them make a decision in a reasonable amount of time. Because a maybe is a no. Like the only yes is an actual yes. If you don't say yes, it's not a yes. But if you hear a maybe, you know, as a founder, you're always like, you know, you're hopeful. It's like, oh, maybe I can just push them over the edge, and that's never
Sarah,
really.
why don't you take that question?
So this is
yeah, a couple of thoughts there, Ram. First of all, it can be very frustrating, and I think what I would do as an entrepreneur is to first of all put some kind of deadline in place. You know, it's possible that this, you know, a round that you expect to take 3 months may end up taking 6 months or end up taking 8 months. Like, it's so hard to predict kind of what the market is going to respond to at a specific point in time. So you don't want to put completely artificial deadlines in place, but I think sharing with an investor, you know, this is where we are in our process. We're talking to, you know, several other funds. We're getting to second, third conversations. We're starting to do, you know, partner presentations. You know, kind of letting people know where you are with others is a way to make sure that they're all kind of moving in lockstep. Now, it's not going to be perfect, but I think it's one strategy. And, you know, you can say things like, we're looking to close this out by Labor Day, by Thanksgiving, by, you know, some kind of mark in the sand, just to give people, you know, a finish line to aim for. And another thing I would advise folks to do is at the end of each meeting, ask, you know, what is your process from here? You know, I understand you have more work to do, you have more discussions to take place, but what can I expect from a process and meeting and timeline standpoint? You know, if you were to get to a yes, what would be the time frame, you know, within which that would happen? Another thing, and last thing I'll share is, I think asking for people who give you the maybe, asking what is it that you would specifically need to see in order to get to a yes. You know, oftentimes as Ha shared, like we have specific like revenue and kind of customer traction goals that we're looking for companies to hit, or be in the ballpark of, before we, really seriously consider an investment of a certain size. And, it's a very fair question to ask, like, what milestones would I need to hit in order for you to be really interested to get this to a yes? And I hope that they'll be candid and upfront, because again, if you hit those milestones, they, would genuinely want you to, let them know and re-engage. That's what I would advise.
Just plus 100 to everything Sarah said. So just keep in mind that investors are really busy. So it's not atypical for them to have taken 20, 30, 40 pitches, or heard 20, 30, 40 pitches in a single week. And so the onus really is on you to sort of push them along. So I love Sarah's idea of just sort of not only communicating where you are in the process, but sort of hey, could you get back to me? It's Tuesday. I'd love to get by next Friday, an answer, or, if you're not ready to give me an answer yet, what other information can I provide? And then the follow-up is really critical. So I end up being very surprised when we maybe during the conversation, I mentioned about wanting to get some additional information from the founder, and then I don't really hear back because the founder is expecting to hear from me, right? And so just I think that you need to take ownership over the process, take really good notes, follow up if you haven't heard back from the investor, and sort of the stated time frame that you discussed in that first meeting, and just continue to email them to get to a yes or no, because a fast no is much better than just dragging it along. And if you've pinged them 2 or 3, 4 times over email and they haven't responded, just assume it's a no. Just assume that they're just not interested. But hopefully most investors will give you the courtesy of just at least getting to you with a response of oh, okay, I'm working on 3 other deals. I can't meet your deadline, but I'm still interested. Here's when I think I can, get you an answer by, or whatever. But you have to own that process, and you need to own the follow-up as well. So,
any words of advice from the trenches of fundraising?
No, my 2 expert colleagues nailed it. Nothing to add.
Perfect. Okay. Well, I think we're just about out of time. So thank you to our panelists. We really appreciate all your advice and having you here this morning or this afternoon. And thank you to the founders for dialing in. I think it's been, posted in the chat, but all of these sessions will be shared again via email. You all registered with your email, so that's how we'll contact you. Also, we'll have an NPS survey. You are our customers, so as Ha mentioned, we want to know how we can do better. So if you can, take a couple minutes to respond to our survey as well. The link will be in that email. And if you're interested in a financial modeling how-to quick session, that is our next and final session. So next Friday, go to spero.vc, our events page, to register for that. We'll have Stephen Wemple, who's our financial modeling guru. And with that, I will say goodbye, everyone, and thanks for joining.